Welcome back to the Rentvesting Podcast. We're roughly 6 weeks into 2017, and here's what we know about the property market. It's showing continued strength. The economy is bubbling along. There's lots of talk about interest rates moving north. Investors are really in the spotlight, particularly around tighter lending restrictions. And politicians, they too are in the spotlight to actually do something around affordability issues. Now, with all this happening, what can we actually expect at a local level, and where are the opportunities right now? So in this two-part podcast series, I'm going to touch on the major focus points of the four main residential markets, and next week we'll have a chat about the others. So anyway, let's just get to it. If you watch the property market as closely as what I do, you'll start to realize that there's some fundamental shifts taking place. And there's been a few catalysts for this throughout the last 18 to 2 years that have taken place. Firstly, and if you've been listening to this podcast for a little while, you'll know that more and more people are actually rethinking the traditional home ownership model. Why? Well, it's a pretty easy answer, because it's never been more affordable to actually own an investment property. Secondly, when lenders actually pulled the handbrake on lending to foreign nationals, it's meant that developers have had to switch their strategy to, tailor their product to the local market and offer incentives to us Australian buyers. Thirdly, in the past 18 months or so, there's probably been more than 13,000 apartments that have been due to commence in Brisbane and Melbourne. They've been deferred or they've actually been cancelled. 5,000 have actually been cancelled within 5 kilometres of the Brisbane CBD alone. Why? Well, a couple of reasons. One, lending conditions have become a lot tougher for developers. I think it's probably the main reason because, they're needing up to 90% in pre-sales, which just results in slower construction starts. And for the punters that are actually buying off the plan, some lenders just feel that there's a bit of a stink to the market, and subsequently we've been seeing some valuations really getting smashed. Another big factor in this cancellation or deferment, it also relates to the actual cost of construction. It's gone up significantly more recently. And, there's no doubt that in some areas there's definitely an oversupply, a bit of a glut in the market, particularly around the Brisbane and Melbourne CBD and fringes. In the coming years, that stock will probably more than likely be absorbed, but supply risk really just depends on the quality and the value of the asset that you're investing in. So heads up, do your research and always seek professional advice before you pull the trigger on an investment. One underlying theme, though, in my opinion, and what will really have an effect on the property market throughout 2017 is lending. Commercial and residential finance deals for investors is certainly going to get tougher. Some of the lending policy flexes that will take place, I think, will probably also spill over into the owner-occupied market. I would expect more stringent assessment, particularly around serviceability. So for the self-employed that are listening in, if you're not showing a lot of income, it could be really tough to get a deal done this year. Interest only? Again, this is going to be really carefully watched. Lenders are asking brokers to provide a lot more information on why their clients want to do an interest-only deal. Even more so for owner-occupiers. Lastly, interest rates. Look, we've probably reached the bottom of the market there, and banks are more than likely going to act independently, and we're going to see some interest rate movements going north probably throughout the year. And look, if you do need to assess your lending circumstances, please feel free to get in touch with me directly for a free consultation. But anyway, why is all this happening? Well, let's start by looking at the economy. It's really just reshaping itself. We're moving away from regional jobs and local manufacturing to more knowledge-based intensive service offerings. Overall, the economy, it appears to be in pretty good shape. And the return to form of the mining sector, more recently with coal and iron ore coming back on from a pricing point, has definitely helped. Population growth, it's slowing, but it's still one of the fastest in the OECD. By 2030, it's estimated that more than 30 million people will be living in Australia. Now, between now and up to 2030, our 4 largest cities are going to need to accommodate more than 6 million additional people. Now, the construction of dwellings need to keep pace, or else we're going to see a lot more pressure on affordability. Now, from a property perspective, there's been a lot of talk on whether a bubble has actually been created. Now, our housing market domestically has had a very long history of solid performance. For there to be a significant downturn in prices, the economy will really need to be in the doldrums. It's going to have a meltdown. Because if we look at the history, in the past 40 years combined, capital city dwelling values have not declined by more than 10% in a calendar year. Now, in that time, the Australian economy has gone through recessions in the 70s, the 80s, the 90s. The GST was introduced. The GFC also happened. And through all of those economic blips, prices haven't fallen by more than 10% in a capital city market. Property is a stable asset class, hence why it's so loved. So let's break things down a little bit further and let's start to look at some of the market activity that's been taking place. And we have to start with the market darling, Sydney. Now, in 2016, values were up close to 11% for the year, which is awesome. Total growth over the last 5 years has been more than 60%. That means one thing: equity made. The majority of inner and middle rings now have an extra 400 or 500k worth of equity in their homes. Sydney's also had an infrastructure boom. Billions of dollars have been pumped into various rail and road projects. $6 billion was put into a casino at Barangaroo. Rental demand, though, does remain high, but vacancy rates are, less than 2%. But what is probably slowing the investment activity in and around Sydney is actual rental returns. And, these individuals with $400,000 or $500,000 within equity, they're looking interstate because they get better bang for their buck. Southeast Queensland is definitely becoming a firm favourite. So in 2017, we should see the foot taken off the pedal, particularly, I think, with what's happening from a lending perspective that I've mentioned. But the Sydney market has been hot for a little while, and I think that we'll see that focus shift to other areas. Now, in my hometown, Brisbane, we're waiting for it to fire. Looking at the market, it appears pretty affordable. Rentals outperform their interstate competitors, and buyers get a lot for their money in comparison to Sydney or Melbourne, which I've just discussed. Now, the economy, though, it's trying its best to perform well, but we've had a severe coal hangover, and we're trying hard to diversify into other areas. It will happen, but jobs need to start to pop in order for the market to do what a lot are now waiting with bated breath for. The supply of apartments in and around Brisbane CBD and the fringes will cause growing pains in those localised markets, but smaller developments just outside those areas are expected to perform quite well. Melbourne? Now, Melbourne is definitely a market to watch. It's been the bridesmaid to Sydney more recently, with house prices increasing about 50% in the past 5 years, which is a fantastic result. Population growth, though, is really strong. It's widely considered to be a world city, and it's very livable. And it's expected to actually have the largest population in Australia within the next 30 years. The economy is actually performing quite well. There's a good corporate presence in Melbourne. Rental vacancies have trended down, but like Brisbane, there's a bit of an apartment glut they need to deal with in and around the city and the fringes. But, aside from that, Melbourne is really expected to continue to perform well for quite some time. Now, over to the other side of the country, iron ore has staged a recovery and the citizens of Perth rejoiced. It was looking pretty rough out there for a while. And, it wasn't so much due to the slump in prices, but probably more so that the construction activity of those significant mining infrastructure projects wound up. So that in conjunction with low commodity prices, and look, we all know what happened out there. With prices continuing to perform well from a commodity perspective, the market has probably also reached the bottom of the property cycle, which means that some feel that there could be some opportunistic buying opportunities coming available. Recovery is expected, albeit that it's not going to be at the dizzy, unsustainable heights that was experienced throughout the mining boom. So, that's a short and sweet overview of what's been happening in the 4 major residential property markets in Australia. We're going to explore more markets in and around Australia next week. But I think it's really important to highlight that if you are out there looking for property investments and have an appetite to do something with the money that you can afford, is that investment does involve risk. It can be as safe as houses, but, not all houses are in great areas and not all houses are great investments. So do your research, seek professional help, and good luck with your future property adventures. Here's to your success. We're going to be back next week for more on rentvesting strategies and what's happening out in the marketplace. If you need some more information in the meantime, be sure to check out www.rentvesting.com.au. Utilize the free resources to hand, and otherwise, we'll chat next week. Bye-bye.